Welcome, everyone, to the next OXBC podcast. And we're very glad today to welcome Anatoly Crachilov. Not Crachilov. I've been mispronouncing his name for the last 2 years, and he's been far too well-bred and polite to ever correct me. Anatoly Crachilov, have I said that correctly?
That's absolutely correct, yeah.
Perfect. And Anatoly not only has become a good friend over the last couple of years and is a founding team member of OXBC, but much more importantly, he is founding partner and CEO of Nickel Digital Asset Management, which is his relatively new baby. How many months old is this baby now?
Coming to 6 months.
6 months old. So it's walking, but maybe a few nappy changes are still needed, or maybe sprinting already. And
we're walking. We're going through the internally we call it crawl, walk, run. That's how you deploy your capital into the market. I think we're in a walking stage already.
We're in the walking stage. Well, that's very good to know. So I want to come back and do a good deep dive into nickel, but we want to get a little bit about you and your background first. But just so that we set the scene, what is nickel? And we'll come back to it. But just give us a quick top line on what is nickel.
Sure. Nickel is a market neutral arbitrage fund specifically focused on digital assets. We happen to be a first FCA approved arbitrage in crypto. We received our approval in April, and that's what we were told by FCA that you are guys the first one, which gives you a preview how young is the industry. But we embraced regulation on the assumption if you were to serve institutional clients, you've got to be regulated. So what we do essentially, we trade volatility in digital assets market without taking directionality view as to where market's going to go. Essentially, plus 10 or minus 10, we should be producing positive absolute return in any market environment.
Excellent. Great. That's a great overview. So you're an institutional arbitrage fund for digital assets. But we want to know a little bit about the background to how you got here and how Nickel got set up. It's probably true that you weren't brought up in the UK. Is that right?
That's absolutely fair assumption. I moved to
the
UK.
Take us back to home and where things started, and I don't know, college and your first jobs.
Absolutely. So home country is Russia. I was born in a family of academics. My father was a mathematician. My wife's father, by the way, was nuclear physicist. They met on academic works, and that's how we met as kids. And ultimately, 20 years ago, we both moved to London. My wife went into hedge funds straight, and she was there for a number of years. I was in banking, working for a few London-based bank. Over the last 8 years, it was JP Morgan and most recently Goldman Sachs. And I left GS earlier this year to set up Nickel, which we'll discuss later on. But when I moved to London 20 years ago, the idea was for a couple of years, I think many of us come here for a couple of years. I fell in love with this city. Essentially, originally was meant to go to the US for business studies. Ultimately did Oxford Executive MBA. So the need to go to the US was not there. And I love London. So that became home. Kids were born here. So that's where the life is.
And how are your kids doing in their times tables and maths tests at the moment?
They are doing pretty well.
And did you and your wife meet on a maths camp? Were you sort of sent off to do further maths as a kid by your parents? Is this something that's been ingrained in you?
The answer is yes. When I was in high school, I did 3 years what is called course by correspondence with University of Lomonosov, which is the top Soviet university. And I was 3 years in the high school. When I graduated from there, my father, who was a mathematician, he actually urged me not to go into pure math, but rather kind of in applied math in finance. And I really had an inclination towards banking. So that looks to me as a reasonable combination of math skills and finance skills. And ultimately, I ended up in banking, which led me to hedge funds. And what we do today is pretty mathematical, I have to say. We may need to touch on the strategy underlying. They are pretty sophisticated, based on multiple kind of on various math equations, and the way we approach market, the way we extract value from the market. So all these childhood backgrounds ultimately played, and nickel is kind of the top pinnacle of math skills applied.
Well, it's interesting, isn't it, how these things in our far backgrounds sometimes knit together at some point in the future, and you can't necessarily see all of the reasons for doing them at the time. But there's clearly a synergy with all of those things now. I remember when we first met in some of the first OXBC meetups back in 2018. You were telling me, were you with the ECRB back in Russia before you moved over to Goldman's? Or you tell me your banking story a little bit, but
BCRB, what BCRB is?
European Bank for Reconstruction and Development. Were you with
yes.
them?
So EBRD is a London-based bank.
Yeah,
so essentially, it's out of London, and that was my first job in London.
Okay.
It's a G7 funded bank, supranational bank. It's based in the UK, but essentially is designed to serve the markets of the former Soviet Union and Eastern Europe. And the whole idea behind setting the bank, which was in 1991, just at the time when Soviet Union collapsed, was to help a transition of this post-Soviet bloc into a bright capitalist future out of socialist past. And the whole idea was that if you allow this post-Soviet area to slip back into socialism, or whatever the mass could have come after socialist attempt, that could have been detrimental to the entire Europe. So the Europe, led by the US, which is the largest shareholder in this bank, funded 20 billion to get to allow this bank to go eastwards and fund projects which private capital at the time would consider as too risky to undertake. But essentially, you need this private involvement. So EBRD would mobilize, alongside its investment, some additional private investments, and help the whole Eastern Bloc kind of come to the proper market-based economy. And that's what I've been doing I was doing it for 7 years, working for the Financial Institutions Group. So what do? We would buy local banks, help them evolve, grow, and then hopefully become an IPO candidate or a target of a larger Western European institutions coming to the region, acquiring local assets. So we were playing this integration role between East and West, if you will.
Yeah. Has it been successful, do you think?
That was tremendously successful at the time, because if you think, there was an arbitrage. Finally, it's arbitrage again. But arbitrage was that you would go ahead of the crowd when private capital would say, well, I'm not sure I want to take Ukrainian or Russian risk. And you would buy assets at what was absolutely market price at the time, say one-time book value, if you talk about financial institutions. And then 4 or 5 years down the road, suddenly everyone awakens to this kind of growth coming from the region. And you have Erste Bank, Deutsche Bank, Swedbank coming to the region in an attempt to acquire local assets. And guess what? Prices are quite different by that time. So I remember us selling in 2005 assets at local banks at 4 to 5 times book value. So if you did nothing, you would make 5 times your money, because you bought the same bank at 1 time book value. But in reality, what happened in the interim, that everything was growing at 30% a year. So your asset has grown 3 to 4 times in value whilst you were an investor in that. Then you have this multiple effect, 5x plus underlying growth, 3x. Hey, you've made 15 times your money on that investment. And I remember by 2006, 2007, there were a number of voices saying like, hey, EBRD is making too much money. It's not a supranational kind of government-owned institution anymore. It should be privatized because of the kind of fee it generates out of this business. So it still remains G7 supranational, But answering your question, yes, it has been a highly profitable business.
So, I mean, what's interesting, just as a reflection on that, is as your career has developed, as a a math student from Russia, and you've worked in Russian banking. You've then come over here and worked from London, facing back east, as well as then facing in a more global sense when you were at Goldman. So you've kind of seen these two financial systems and political systems and some sort of integration between them. You've also seen an extraordinary discovery of a valuable asset that some people were late to the market and some were early in terms of financial institutions in the East, and then Western institutions buying in, as you say, at 5 times book value. All of that to say, as background, how much did those things feed into your understanding and discovery of blockchain and Bitcoin?
So over the last 10 years in my career, I switched from private equity into kind of more liquid markets. Specifically, I was dealing with portfolio construction for large institutional clients and family offices. And essentially, your job would be to advise client on proper composition of the portfolio, starting with conventional assets or asset classes like fixed income, equities, going into alternatives, which would do hedge funds, private equity, commodities, real estate, and your role would be to combine these in a coherent portfolio, and then monitor that, rebalance this portfolio as the market evolves. So that's what I was doing in both JP Morgan and Goldman. And then roughly 2.5 years ago, when I was at GS, we got a flow of requests from our clients who essentially were coming with the following question. Hey, we're looking at this, if we can call it a new asset class called digital assets, and we have no exposure to it, but are we missing something? Do we have to be there? Or it's largely a speculation, the way we see it, and we should ignore it. And Goldman at the time came back with a piece of research, which was not really kind of a sale pitch, but rather an overview of the market. And few key messages were, A, it is a new asset class. It's here to stay. It's not just coming and go. It will, over time, become an investable space. That's the first message. Second, as any new technology, it's going to go through massive ups and downs in its kind of price action. For a simple reason, the market is attempting to find what is the intrinsic value of underlying blockchain, of assets sitting on blockchain. And this volatility is really not for everyone. So if you, Mr. Investor, is willing to take a long-term view, and more importantly, stomach the volatility, then there is a significant appreciation potential in the entire blockchain industry. If, on the other hand, you can harness the volatility and take advantage of the daily moves, this is a beautiful asset class to be in. And you can see where I ended up ultimately.
See where you ended up. But just where you ended up, what was your sort of moment of, your aha moment with blockchain and Bitcoin? Did you have that before the Goldman research paper?
No. Actually, the whole idea, but the message was kind of invest your time in understanding the technology, because technology is here to stay. And before I could speak to my clients in a meaningful way, I immersed myself in deep dive in the entire blockchain technology, and actually was fascinated by the underlying beauty of math solutions, which is underlying blockchain. The whole structure of Byzantine general problem, which ultimately was solved through the blockchain. Then the whole consensus mechanism, which was invented and then brought to life through various blockchain solutions. To me, it was a point of really aha, as you say, moment. And I started to dig deeper and realized people much smarter than I am saw value of this technology 5 years before that. And whilst I, as many of us perhaps, had been rebuffing the idea of whole crypto for years, suddenly I realized that, and I think what struck me, if you look on the website of Princeton University, there are 12 hours of video lectures recorded by 4 Princeton professors, really 5 or 6 years from now. And they first gave you a deep dive into underlying technology, and then gave you the potential of the entire blockchain as a technology and what implication may have on various industries. And to me, that was an incredibly important moment. I realized that as the time was progressing and I was talking to my clients, instead of spending 10% time on digital assets, we ended up discussing 80% of the discussion airtime was around digital assets. So later on, I went to do the course in Oxford, our blockchain strategy course. That's how we met, and I really appreciate that was kind of a great step. And I think what Oxford gave us all is this it forced us to think how it's going to impact your particular industry, in my case, finance, or what potential opportunity it can bring the whole blockchain industry. And to me, that was a point of no return. Essentially, I realized this is my next step because this is a growth market. And that's where I can add value by helping the whole industry develop. My initial idea was to switch into digital assets desk within GS. And Goldman has a desk called Digital Assets. The whole idea behind desk was to become a market maker for other, say, hedge funds like us, right? Or help facilitate institutional investors access to the market. And whilst the initiative is still there, I think what happened, it was put in a slight hibernation mode when the entire crypto winter came upon us. And whilst there was expectation that the number of funds should be X, in reality, kind of counterparties, in reality, it was just a fraction of what it could have been should the market develop as expected. So Goldman put it on hold, and I had to make a decision whether I wait until the market unfreezes and goes into crypto spring or summer ideally, or do I take a more aggressive move? And essentially, what we do today is my answer. I was willing to break from relatively comfortable lifestyle at GS and take a risk of entrepreneur. This is completely different. You build your business. It's far more demanding. My wife told me, like, listen, we lost you somewhere in blockchain world. But of course, there is a benefit to that, and there is significant prize we are fighting for. And I think we have a great mission of opening this market to institutional investors. And that's what our kind of fundamental objective is.
Tell us a little bit then about, if you like, the problem that you're solving, because, I mean, why another hedge fund? Presumably, you guys have got a different approach and a different philosophy or mission. What's the problem you're fixing?
Mm-hmm. Yeah. So when I look at the market, this market requires what is called professionalization, if you will, right? And allowing access to digital asset market for institutional clients. Because when you look on the fundamental story behind digital assets, there is a reason as to why institutional investors would love to have certain allocation to digital assets. First, there is a massive, what is called diversification effect, right? Because correlation of digital assets with conventional assets, such as equities and fixed income, is extremely low. The R square is less than 2%. As a matter of fact, as a portfolio manager, you want to have this asset in your portfolio because it behaves in a completely different manner. Second, if you look on Sharpe ratio, equity markets over the last 3 years delivered Sharpe ratio at around 0.87, which is not bad, but digital assets delivered 1.2, which is like 50% better, which means with all due respect to risks and volatility, you are being paid 50% better on your unit of risk you are taking in your portfolio. And that makes sense of that creates the reason as to why would you consider allocation to crypto in your institutional portfolio. Now, another question would be like, how much would you allocate? And I would advocate that it shouldn't be kind of sell everything by crypto. That would be a ridiculous idea because of the volatility. However, allocating 1, 3, maximum 5% makes total sense. Because say if you were to allocate 3% and the worst scenario has unfolded and the whole crypto market would go down to absolute zero, your risk is clearly understood. You would lose 3% of your portfolio. However, if the history repeats itself, or at least rhymes with itself, this 3% allocation can double your entire wealth or your entire portfolio in the next 5 to 7 years. And that's the appreciation potential, which is kind of part of this evolving asset class. And actually, the name nickel, that's exactly where it comes from. Because if you look on metal markets unrelated to blockchain, nickel as the metal is, you would add it to regular steel to get high grade steel. So essentially all these temperature resistant steel, impact resistant, all stainless steels, it's because of nickel. Question, how much do you add nickel? The answer, 3 to 5%. And the impact is so dramatic. So
who dreamt up the name? You or one of your co-founders?
My co-founders.
It's great. For that reason, it is a great name. 3 to 5% to make a high grade, I presume bulletproof steel.
Absolutely correct. And kind of you improve qualities of your institutional portfolio, right?
Yep.
And you're not overexposing yourself. The risk is contained. And that's exactly what hedge fund managers are looking for, to this asymmetry of returns. Your downside is limited, your upside is disproportionately large. You want to have an exposure to that sort of asset. So call it a call option. In case digital asset space evolves, you want to have some long position. So, and because we are a crypto, as we see ourselves, a digital asset house, we thought that's kind of a nice angle, right? How would we communicate the value added of digital assets to institutional investors? Now, coming back to what we do, we are not really a long-only manager. Our strategy is pure market neutral, which means we do not express the view where market going to go. And we thought that this is a far kind of more comfortable way for institutional investor to take their first step towards crypto, because essentially you're not really jumping full you're not jumping in a long position and not you overexposing yourself. What do? You apply conventional financial techniques to the new market of digital assets.
What does that mean? The everyday listener, what does that mean?
Absolutely. So if you look on our background, our three partners, Michael and Alec, who are my partners, and me, we all come from traditional finance. I think we cumulatively bring like 50 years on Wall Street banks and major hedge funds. And for the last 2 years, we've been in digital asset space, applying these particular techniques to the new asset class. Now, what do we do? And Michael, in particular, has been in since 1992, working for the banks like Bankers Trust, which you would remember at the time was the largest derivative house on Wall Street, even before Goldman took this top spot later on. But his job was arbitrage on fixed income. Now, when you arbitrage fixed income, you look on the price discrepancies around various venues around the world, or you would look on future basis when your price on future goes in dislocation from the spot price, and there is a certain fair value what this dislocation can be, say 1%. If dislocation goes into 5%, this is unsustainable, because at expiry, when future expires, both future price and spot price come to the same there is a zero spread. If spread for whatever reason goes into 5%, you can exploit that. Essentially, you take a long position in spot, short position in future, and you just locked this 5% differential. All you need to do is to wait for the expiry. You can put some smarter strategy around that, but this is the fundamental structure, how you approach these dislocations in the market. So all these techniques, they haven't been invented by us. We borrowed them from Wall Street and just applied to digital assets. So if you kind of look deeper in other strategies we run, so I've just mentioned future basis. Then the other strategy is called volatility ARB. Kind of what you do here, you play on differential between implied volatility and realized volatility. So implied vol is something how the market sees evolution of, say, Bitcoin price over the next 30 days. And psychology of human beings implies that expectations are pretty often are very high. You expect the assets to be super volatile. In reality, realized vol, what in fact has happened, and we're going to know this 30 days down the road, usually is lower than implied volatility. So you can play on this differential, basically selling options at the implied vol, a high level, and then you know that by the time it's going to become realized, it's going to go low. So kind of you short it at the high levels, and then it's kind of converges to realized vol. So this is volatility arbitrage. Other things which we've borrowed from FX market is called triangular arbitrage. So the fundamental approach here, if you look on the conventional currencies, you may start with United States dollar, then convert it into euros. From euro, you would go to sterling, and from sterling back to US dollar. In theory, you're not supposed to make money on that. If any, you're supposed to lose on fees and commissions, however small. However, when you apply this technology to digital assets market, you can extract value from that sort of triangulations. Why would you do so? Because in an ideal, in a perfect market, the market, say, is in a perfect balance. All the currencies are perfectly cross-referenced against each other, and there is no really spread. However, when your free currencies are moving 10% a day, ability of the market to maintain this perfect balance is negatively impacted. And basically, the balance cannot be maintained at all times. For us, if there is a deviation as short as milliseconds, we would take advantage of that. Essentially, you would not allow the market to be, say, if it's supposed to cost 100 units, to be 99 on one market and 101 in another market. We would eliminate this difference, and by virtue of being present on the market, we would bring it back to equality, to 100. And that's triangulation, which we do, and we look at the global scale. The beauty of digital assets is it is 24/7. And if you think this is a fundamental difference to the conventional markets, because equity markets would shut down on Friday, 4:30 in the afternoon, and people would go for beer. Well, we're going to reopen on Monday. Not in crypto. Crypto works 24/7, which means I have simultaneously, and we trade on 15 exchanges roughly today around the world. 3 of them in the US, 1 in London, 1 in Malta, 2 in Hong Kong, 1 in Singapore, 1 in Tokyo, and 1 in Amsterdam. Essentially, kind of you have pretty global coverage. And the beauty is that both San Francisco, London, and Tokyo are reopened at the same time. Now, if you think, if there is one asset, say Ethereum, which is traded on all 3 venues, and then there is a news break, what's the probability that San Francisco, which is widely awakened, and Tokyo, which is in the middle of the night, would react at the same time simultaneously? Or they're going to be at least fraction of the second difference in their reaction. And I would bet there's going to be a difference in reaction. And if there is, we can trade on this difference and essentially help the market be more efficient. I would like a person waking up in Australia and with the idea of taking exposure to digital assets. I would like this person to know that the price he would pay in Australian dollars is a fair price. And he is not being screwed by 2 to 3% for the simple reason that, well, Ethereum is traded primarily against United States dollar, and your Australian dollar is a secondary currency. So there are going to be some inefficiencies, 2 to 3%. I don't want to see that. I want market to be perfectly efficient. And essentially, that's how we extract value from the market and help market be in equilibrium. Now, many of our investors, and we have 15 investors today, for 80% of them, in exposure to crypto market through us is their first ever exposure to digital assets. And that's how I see our role here, our mission here, help institutional investors access this market. And the reason they are comfortable, because for them, this is, as I mentioned before, we're applying conventional technique to digital assets market. And I know this is their first step. Later on, they will come saying, okay, we tested, we're comfortable now to take a greater exposure. What else do you have in your toolbox?